the assets that pump the most are the assets that are harder to value, like stuff that are like has like very high hallucination yield. And like, I think there's always an incentive to do that. And like, unless these funds get like super wrecked, this is just gonna continue. Like, that's kind of like how I see it.
Not a dividend.
It's a tale of two quants.
Now, your losses are on someone else's balance sheet.
Generally speaking, airdrops are kind of pointless anyways.
Unnamed trading firms who are very involved.
Alec.eth is the ultimate pump.
DeFi protocols are the antidote to this problem.
Hello, everybody. Welcome to the Chopping Block. Every couple of weeks, the four of us get together and give the industry insider's perspective on the crypto topics of the day. So quick intros. First, we got Tom, the DeFi maven and master of memes.
Hello, everyone.
Next, we got Robert, the crypto connoisseur and czar of Superstate.
Good morning.
Joining us today, we've got special guest Mosi, masked maverick and the magnifier of misdeeds.
Jam.
I think that's the longest title we've ever used on the show.
Well, the thing is, like, he's an Anon, so I don't know where he lives, don't know what his title is, don't know what he does for work. All I know is that he is out there and he's on the prowl. So anybody who's up to bad, no good stuff, Mosi's coming for you. Finally, I'm Haseeb, the head hype man at Dragonfly. We're early stage investors in crypto, but I want to caveat that nothing we say here is investment advice, legal advice, or even life advice. Please see choppingblock.xyz for more disclosures. So just to give some background here for the audience, we are all here fans of Mosi and what he's been doing out there on his Twitter handle at Vanacharmer. But Mosi, how would you describe yourself, what you do, and how should people understand who you are?
Yeah, actually, like, I think I'm just like, honestly, like, another anonymous dude. I think, like, in general, like, that's the beauty of crypto, that no one really tries to see you for who you are, and like, they just look at your ideas. Personally, I think that's like very nice. And Anon, like, I think it's been pretty real to be Anon for me. I've been in crypto like for a while. I've worked full time in the space, I think now for a couple of years. I don't want to like dive too deep into my background because I think it's like not like as important. I personally I like to focus mostly on ideas, but yeah, I basically been in crypto for a while, doing like a little bit of everything. And yeah, like, honestly, I just created this account, like the Mosi account, just to understand markets like better and be able to connect better with like crypto people. And also, I think just showing people that, like, the only thing that matters in crypto are like your ideas, and like, that's it.
Okay, so maybe it's worth giving just a little bit of context setting on what made you so stand out as an Anon within crypto. So I'd say you were one of the central figures in calling out two particular blowups. First being Ohm, and the second being Movement. And specifically, you were calling out a lot of stuff about the market microstructure underneath how these market making agreements and these, particularly around the subterfuge that many projects are doing around their float dynamics. Do you want to talk us through what would you say is the main problem you see today with market structure that ties together these tokens as well as others that you've been calling out?
So I think the main issue I see with market structure is the lack of knowledge. I think like now, like, crypto resembles pretty much like an MLM scheme, because it's like you have like the exchanges on top, like sort of like pretty much like swindling everyone, because I think
I don't like this analogy. Let me interject.
Okay. Yeah.
You can continue it. I just want to lodge my complaint.
Yeah, okay. I will also lodge a complaint here. Yeah.
Like,
for the record.
No, but I think it's like the lack of like knowledge on like how this works, because I think exchanges are like pretty tough because they pretty much end up like throwing everyone under the bus, including like founders, because like I think they're very hard to deal with. And I think in general, like, I would say like they make the most money from crypto. Then you could say like you have like market makers, which I think have like pretty like privileged information, and like thing in general, like retail flows, like pretty much that's what like market makers want, right? And like I think it's very easy for them to like profit from those. Then you have like you guys, very like BCs and founders. Then you have sort of like KOLs, and then you have like retail. And I think like that disconnect is actually like pretty bad, because like I think in general retail investors don't really know. I don't like how these dynamics work, and I think it's very easy to like manipulate like some things to make them like look nice. Like, for example, like I think you can have 1% of like your float out there. Of course, like you're not going to rebuild it. And like the first thing you see as a retail investor is, oh, this project is worth like 20 billion. And I think even like some founders like do like to play into this dynamic as well. I was speaking to a founder, I'm not going to name him, but hey, I was like, yeah, like if I think of the CoinMarketCap webpage as like an SEO thing, And I'm like, bro, like that's just like fucked off, you know? Like I think that's like the worst way to think about this because basically like presenting a very fake thing of what your project is. And also, I think many people are using crypto still do not understand how liquidity dynamics work. Because I remember I jumped on a space, I think it was like not a good space, like like by Mario Knopfler or something, and they were like, oh my God, crash, like it erased like 5 billion. This is like super bad for crypto. And I'm like, what I was thinking, I was not speaking on the space, but I was just like, guys, like, this party was never worth this, you know? It's just like a weird illusion. But this was never worth this. But yeah, that's sort of like what I think is the main, like, personally, one of my main concerns.
Okay, so let me maybe ask you this, kind of reverse engineering a little of your criticisms here. Let's say that you're in we're in a different universe and we have Shadow Mosi in front of us. And Shadow Mosi wants to scam everybody in crypto by playing all the games that one could possibly play to create a manipulative high flow token and kind of, rug pull everybody possible. How would you do that? Can you kind of sort of walk us through mechanically, how do you create like the worst of the worst, artificially inflated token?
Yeah, so first you have to make sure that you have to like tightly control token supply. You have to make sure that the token doesn't get in the hands of like as many people as possible, and you have to make this very hard to track. For example, having a super bad explorer. I think like that's like followed by the first step.
Like Terra?
Yeah, I'm not gonna names here, but no, I'm not gonna name names here, but yeah, that's like I think that's like the first step.
Okay, step one, terrible explorer.
And like supply control, that's like very important.
Supply control.
Supply control is like the most important thing. Then I think you can tell like, so let's say like there's actually 1% of the float out there. You give, let's say like 5% to your market maker and you tell him to trade against traders. And I think that's a very favorable dynamic for like your market maker or your market makers because it's like the way I see it, it's like you're going to be trading against people who know way less out of the token than they do. So like they can sort of like liquidate all the shorts and liquidate all the longs as they see fit because they own most of the supply, right? So they can use like all the guys using leverage, just like exit liquidity. And like if they trade with like a P&L ship, they can sort of like rapture with the foundation or with the founders. Then as a founder, you can also like cash out with the market maker. I think that's also a pretty common practice nowadays. Usually like the founder never cashes out. Yeah, or like, well, of course, like they do if it's like a more legit thing, but that's sort of like a way to like obfuscate this because it's like if you give the tokens to your market maker and then they transfer it to like another entity on your name, it's like much better for you as a founder because like the chances of getting caught are like way lower. And yeah, like, and then like just run the scam until basically like your project like slowly decays. I think one thing you can do as well to pump the price of your token is like sell OTC and buy liquid. Many people are doing this now. Like I think you would actually be surprised by like how many people are doing this. And yeah, like I think that's.
So can you explain this? Sell OTC and buy liquid.
So essentially, it's like foundation selling like tokens. Like let's say like I'm an IP blockchain founded by a very big firm in San Francisco, and I approach you guys and I'm like, guys, for selling OTC lot tokens for 50% discount, and the unlock in June. And then I take the money from you guys, I give you the OTC tokens, and I use that money to like buy the token on the open market and pop the price. And the thing is like essentially a Ponzi scheme because like when the token unlocks, right, of course, like investors are going to be rushing to sell, right? So it's not really sustainable. Mantra is also running the playbook. And yeah, that's it. It's just not sustainable.
Wait, Mosi, how do you know that they're running this playbook?
Well, like with Mantra, it's because the guy literally went to the podcast and he said they were doing this. Like, it was like pretty like, I'm not making it up. Like, you can look at the podcast.
Oh, I'm not accusing you of making this up. I just want to know what like hard facts and receipts you bring.
Yeah, of course. So he went in a podcast and he said, yeah, we're selling OTC and we're buying some back. And the interviewer was like, yeah, that this is like pumping the price. So the guy's like, no, it's not pumping the price, but it's like, I mean, of course it is. Like, I mean, if you buy like 10 million worth of a token that has like no liquidity, of course it's going to pump. And the second thing with Mantra was that basically they were holding like 5 billion at the top on like one wallet, which they claimed was like a mirror bucket wallet. But if you check the receipts, like they don't really match. Like either scan and like Minscan, which was there. Well, they're like a sort of like customers a gate chain. So like they use like Minscan as an explorer, like, but still like the transactions like don't really match. So that's how I knew like, okay, this is not a mirror bucket wallet, like no way. And with Story
So
Protocol,
mirror bucket wallet basically means like a bridge.
Yes,
right.
exactly.
It's supposed to be bridging into this other chain, and it wasn't doing that one for one.
Exactly. It's a way that burns tokens. Like, let's say like I want to bridge like 1,000 ETH to Solana, and then it's like, it basically like holds my 1,000 ETH and like then sort of like deploys like WETH and then burns it back when I try to bridge the WETH back. Example. But yeah, like that's how Mirror Bucket was. But and with Story, well, with the IP blockchain that it's not going to be named.
The IP blockchain that shall not be named.
Have you seen like a lot of like OTCs? That, like I know many friends that have been offered this deal, and
you just have friends out there because of course in your bio it says you're just a kid from Africa trying to make it. They're offering OTC to kids in Africa now.
Well, like I might or might not be a kid from Africa. That might or might not be true, but again, like I've seen these deals. Like I can actually like show some screenshots that this is happening. But
so how do you know who's selling, right? Because it could well be that, okay, it's like some angel investors, it's some small funds that did the deal. What gives you confidence that, okay, this is the foundation doing some kind of Ponzi-like thing?
Yeah, so for some of the specific cases is that you get approached by the market maker. Or like, yeah, I mean, it definitely also like be like some of the investors, but I think it's like also the inorganic like price action. So I also have like some KOL friends, and essentially like for this like IP blockchain that we're not gonna name, at some point I think in April the price was around like $4, and there was a 0.1% KOL unlock that only like KOLs knew about, and like the price went from like 4 to 3 in like one stop. I think this is like the result of like a highly like inorganic like price action. And in general, I think you can sort of like see it as well because it's like usually the crypto markets are pretty correlated. So when like, I don't know, like Celestia is dumping Ethereum, like I don't know, like when Ethereum is dumping, like Celestia is probably dumping too. And like in general, all their like normal alts are like sort of like correlated. But with these things like Ohm and like the other blockchains that we're not gonna name, you sort of like see the price action like super, like just, it just like keeps going up on like a super red market, or like it's unaffected when everything else is going down. And that's sort of what you see. I think you also see it on like the Solana price action as well. I think like that's another like good chart to look at where it just went from like $3 to like $2 in like seconds. And it's like, if you look at Solana, it's like, it has like absolutely no traction. Like there is no retail demand for this. Like no one wants this asset. And I think something very telling for the IP blockchain that we're not going to name is that they claim to have a lot of traction in Korea, but Upbit, which is the biggest exchange, like I think many people think they're listed on Upbit, but they're not. And I'm gonna leave a little bit of room to you guys to think like why it's not exactly listed, but hey, yeah, that's what I'm gonna say in that regard. But yeah, I think it's hard to identify who is selling OTC. That's for sure.
Okay, so. Well, maybe one thing to also clarify in the playbook you just laid out about how to run a scam token, you're not going to be able to do this with most market makers. Most market makers won't do this because, of course, like this is super illegal. What you're describing, like what you're describing, is clearly market manipulation and or fraud, right? And in both these cases, in order to do this, like how do you actually cash out for fiat and make away from this whole thing?
Well, I think the best way...
Because eventually this will catch up with you, right? Because if there's no organic demand, eventually this thing is going to pancake and people are going to be really, really mad.
Of course. I think you have to like try to soften the blow as much as possible. I think if it's something like, it's like really bad because like you can see it like, okay, it went down like 90% one day, like what's happening here? But I think I'm not giving anyone advice here, but I think the best way to cash out is again to like a market maker that is willing to do this. I do agree with you that not all market makers are willing to do this, like especially the ones that are regulated are going to tell you like, why not doing this? Not like some definitely are. And I think if you cash out to one entity, it's very hard for it to like catch up with you because I mean, you can obfuscate it legally like pretty well. I think also like, I guess you guys know this as well, that like some of these entities are not even in like the founder's name. they're also on like someone else's name or like on like a lawyer's name, so it's very hard to like track. And I think it's also they're also in places where like regulation is a little bit more lax. Like, of course, like if you want to cash out to an entity in the US, it's very likely you're gonna get in serious legal trouble, and like it's not good. But if you cash out in like Dubai or I don't know, like St. Kitts and Nevis, I think it's a little bit more lenient. And
Wow,
you can
you're
get
really
pretty
laying out the
good.
playbook here. Okay.
I get it, like not encouraging anyone to do this. I've never done this, so yeah.
Yeah. Okay. Supposedly. Okay. So how
Yeah,
do
you
we
are an
fix
Anon.
this?
You are
You are
Anon.
an-
You could,
okay,
you
look,
could have
we
done
will-
this.
I could have
Look.
totally done this, but again, like Jude, like I've been accused of so many things. Like some
He's just a poor kid from Africa. Let's not pour more
exactly, man. Listen,
more
keep it
program
simple.
on him.
Keep it simple,
Yeah.
man.
So Mosi, how do we fix this? How do we fix it? Like, I look, there's always been shady stuff in the corners of crypto. It's been true as long as I've been here, right? But it does feel like most of that shady stuff. Well, actually, no. Now that I'm about to say, oh, it didn't feel like it was happening as openly. That's not true. It actually was, but it does feel like it's gotten more sophisticated. As the market has evolved, the norms around disclosures have evolved, the expectations around, okay, you're going to tell us when unlocks happen, you're going to tell us how many of the tokens are here or over there, the amount of circulating tokens are supposed to be better labeled today. So the disclosure standards have improved, not a ton, but they're definitely better than they were a few years ago. And yet we still see things like this, where people are misrepresenting what they're doing with their float, they're misrepresenting supply dynamics. And exchanges are also more sophisticated now than they were in the past. They are actively policing this stuff to the extent that they can. Of course, Movement got delisted, Web3 port got shut down. So we know that the exchanges are trying to crack down on this stuff, but they're not succeeding, right? Or at least they're succeeding a little too late compared to what we might otherwise want. So as Mosi, what would you say is the playbook that we should be following, that the exchanges should be following, that people who are regulating the space should be following to prevent stuff like this?
So, well, like I'd say, like we could do several things about this. I actually think that some of the things she said about like disclosures were actually like pretty bullish, because I think like most of these issues stem about like people like not knowing how this like liquidity dynamics work. First, like I think you would be very bullish if like exchanges could disclose like, okay, who are their market makers, like what percentage of the supply they have. Also, for example, like I think another thing is sort of like tracking what the market makers are doing. There are already tools for this now, but it's mostly used by like internal teams. They're like, okay, we have this tool on, like we're gonna track what a market maker is doing on Binance, because you need to track their KPIs and you need to be like, okay, these guys are actually providing liquidity or are they doing nothing? So that's like what, like I think open sourcing these tools would be very useful. I'm not sure if there's an incentive for that, but it would be useful. I think making it clear that even with like low float tokens, like there are always like two markets, the liquid market and the OTC market. And usually the prices is for quite a lot. Like it can be even like 80%. Like you can buy OTC at like 80% discounted, like you have enough size. So that's like one thing. And the other thing is like that I think would be very important that I think we don't really see is that you'd be good to know what investors are doing. And it would also be good if like SAFs have clauses for these, and I think SAFE and token warrants do as well, which is that you cannot just cash out OTC, right? Not without team's approval, right? Like that's not how it should work. The team should be like approving these deals, because I mean, like I do agree around now, like if you're a fund and like you're super wrecked and like you need to cash out, like that's sequent. But that's not how it works in practice today. Like these clauses are like never respected. Like people just cash out and be like, okay, yeah, we sold our barrel stock at 2 billion, we're out. And I think
the reality is that with all of the financial instruments available in crypto, it's very hard to police. You're absolutely right. Most of these terms when VCs are investing involve, a term against hedging, term against selling. So like you must maintain your price exposure to this underlying asset. You can't go, short perps or something in order to hedge out your assets. But of course, it's hard to police, right? And like the exchanges aren't going to cooperate in enforcing this. So it's kind of honor system. That being said, I know of at least one case recently where a firm basically got their SAFT deleted because the fact that it was discovered that they were basically hedging their exposure to a token that they had invested in as a VC. But it's very difficult. It's very difficult to find when this stuff is happening because it's crypto. You can really, you go put a short on Hyperliquid, who's going to find it?
No, for sure. I think it's very hard to find. That's not like, I completely agree with that, but I think it's also like, an issue with like the underlying market structure that I think there needs to be like bigger consequences for people who do this, because I think it's also very bad for teams. Like I was talking to Tom before we started recording, and it's basically like, as a builder, you do not want an investor that it's like, okay, I'm going to go into your round and then I'm going to go sell for a day zero markup to like a nation fund. That's it. The last thing you want as a builder, like you want people who are like aligned with you and aligned with your vision and are going to be in the trenches with you, like building like long term. This is like not what you want, you know? So that's but so yeah, like I do think it's like hard, but I think if firms know that they might risk losing their SAFs, it's a little bit different. And it's like, I think it's also, if like exchanges like do cooperate on this, which I don't see an issue on like why they won't, because like, I mean, exchanges like, they're like pretty
It's just
bad.
more work for them. Yeah, it's very hard to build the infrastructure to do that.
It is more work for them, but I think the value of an exchange is like slowly like decreasing, especially with options like hyperliquid, because it's like, the way I see it, it's like, when you list a token on an exchange, it's not there like bullish anymore. You know, and like this is actually very, very exchanges, because like the revenues are going down, and like hyperliquid revenues, for example, are going like way up in comparison. And I think you can see it because like they like feel threatened by other options.
Well, but to the point I just made, you know, let's say Binance starts enforcing this, which again is like very, very complicated to do, is they have to go collect everyone's SAFs and they have to go enforce that, okay, this person XYZ is not allowed to hedge. Like we just talked about Hyperliquid, right? If Hyperliquid has market share, how is Hyperliquid going to read a bunch of SAFs and then like enforce hedging restrictions on certain accounts?
I think it's a little bit easier there, because it's like, if you know how much investors own, I think it's a little bit easier to see if someone is hedging. Because like, in general, like, I don't know, like if you own like, let's say like, I don't know, like 2 million Mona tokens, and the day it goes trading, like someone goes and like hedges for like 2 million, like it's pretty like, I think of course you're not gonna do that, but I think with Hyperliquid, it's a little bit easier to track because it's all on chain, you know? And it's like, with Hyperliquid also, like everyone knows like who the like big wallets are, for example. And right. I think it's
look, if you're using your Monad tokens as collateral to short Monad, then like, okay, yes, that obviously is going to show up. But again, taking a step back, Tom, what's your take on the picture that Mosi is painting here about some of the infrastructure problems, or sorry, market structure problems?
Yeah, I mean, I think we were talking about that a little bit before the show, but in my mind, this does seem ideally like a little bit of a self-correcting problem where, hey, if the best projects won't raise from VCs who are doing this, then that sort of flushes out some of the bad capital. And so maybe it's a time horizon question. Maybe it's the market is so big that there's always going to be this stuff on the fringes that people see that, you know, ends up getting terrible stories like this. But it does seem like one of those things where it actually really benefits very few parties, if any, to kind of have this kind of, you know, behavior take place. And so it seems like, hey, like you said, VCs who do this, people find out, reputation goes down, they get less deals, less access, and sort of the cycle repeats. And so I don't know. I'm curious what you think about that. And I've also kind of been reflecting on maybe the market more broadly, where, you know, I think generally when people think about kind of scams in crypto, it's, there was a vulnerability in the contract and someone stole all the money. Or I think a little bit back to like ICOs, when teams would raise a bunch of money and then not really ship the thing and kind of disappear. And I guess, like, do you think this is better or worse than ICOs? Because, or like the bad ICOs. So in my mind, the bad ICOs, it's like, at least you know what you're getting into, right? Like the terms of the contract are very kind of clear. Like you can do your own kind of underwriting around the team or the project or the terms or whatever. Here it almost feels like you don't know the contract that you're entering, right? Like you think this is what the float is, or you think this is what's happening with the unlock, but in reality, it's not what's happening. And so if anything, it's like, and you know, as you've mentioned, a lot of this is happening behind the scenes. So it's you can't even, you know, diligence it even if you try as a retail investor.
Yeah, so I don't know if it's like so much of a self-correcting problem unless these funds end up losing money. Like that's the way I see it. I think like actually like many funds are probably going to zero, because it's like, the way I see it, it's like you do have like as a fund, especially if you raise a huge fund, you do have an incentive to deploy capital on things that do not make absolutely like any sense, like an IP blockchain, because it's like you raise so much, you don't want to return capital to investors and you need to deploy it on something, right? So you're going to like go find an asset with very high hallucination yield and try to sell it to retail as much as you can, because you know, like in crypto, the assets that pump the most are the assets that are harder to value, like stuff that are like has like very high hallucination yield. And like I think there's always an incentive to do that. And like unless these funds get like super wrecked, this is just gonna continue. Like that's kind of like how I see it. But I do think it is a self-correcting problem, like when many funds go to zero by the end of the cycle, which I think is gonna be the case. Or like funds like they are like also like not able to like raise from their LPs because like they're best. Because in the end, like the LPs are paying for this, you know? So that's kind of like how I see it.
Well, so let me push back on that. Look, I don't think at the end of the day that any of these funds want to invest in this hallucinatory crap, right? We've invested in total of over 100 portfolio companies at this point over the course of Dragonfly, and
Wait, only 100?
there's definitely more. I said more than 100. More than 100.
I would think it's like 200 by now.
It's maybe around 200. So I don't know exactly, but there's definitely stuff in our portfolio that is hallucinatory crap. Like you invest in enough founders over time, some of them are going to get desperate. They tried things during the NFT boom and that didn't work and they pivoted and they're just like wandering through this desert, hoping that anybody gives a shit about anything they're doing. And they just find something that somebody is willing to buy or somebody's willing to retweet effectively. And over a larger portfolio, you will, with probability 1, you will get something in your portfolio that you're not proud of. I don't think anybody goes into an investment obviously there's some people who do go into an investment saying, oh, this guy's going to buy back their token in the open market. That's why I'm bullish. But I don't think anybody goes into a deal expecting that. Now, IP blockchains aside, like there's always bad incentives in crypto. And there are a lot of founders who get swayed by those bad incentives. And I think as VCs, what you want in the best of worlds is that your founders are going to do it the right way. They're going to sort of chart an honorable path through the industry. But I think there's a difference between the funds that are doing this over and over again, and you find them on the cap table of multiple of these kind of fraudulent things, and especially the ones who are investing later on when it becomes more and more clear this thing is vaporware, there's no real there. Like, how could you have diligenced this and arrived at, yes, I should invest? And there's other ones who invest earlier on and they don't know necessarily where it's going. So I think there's some gradations to be made. I think there are funds that are really hurting from this. And to the point for Tom about self-correction, like it's always been true that there have been scams in crypto. And it's always been true that there have been bad actors in crypto. And there is some degree of self-correction in that the scams never last that long, right? Every scam in crypto I've ever seen is not here anymore. It pancaked, it died at some point, it blew up, a bunch of people lost money, and a bunch of people lost reputation over it. And that doesn't necessarily mean the harm is fatal, right? Some funds that invested into some scammy stuff are still around. They're not top tier funds anymore, but they're still kind of doing their thing, limping along, making investments. But the people who built their career off, this is my strategy, is I'm going to invest in fly-by-night ICOs and flip them as fast as I can. Those people are all gone. And the same thing in people who are flipping DeFi coins or food coins or people who are just looking at the most cynical, deleterious stuff. None of those people are here anymore. I remember them all. They're all gone. So I do think there's some degree of self-correction. It's not fast. It's not as fast as we might otherwise like. And maybe we want to do more to accelerate that process. But it's definitely true that it's self-correcting.
I mean, to a degree, it is self-correcting, but I think like now it's like, if you look at the market structure again, you was like, especially again, for VCs that raise like a big fund, they do have an incentive on like deploying capital on something that might have like a huge stem or that they can sell as something that has like a huge stem, even though it doesn't because it's complete vaporware. So I think like that still exists for sure. I think that there's also like a lot of like comparison, like for example, like you guys invested in like Borf. And I guess your thoughts were like, oh, it's sort of like similar to base, like it's going to be bullish, right? But then it's like the team doesn't execute it, like does like whatever the family want, right? So it's like, that's something that of course, like you cannot control, but I think it's also something that it's like, if you look at it from like first principles, like why should something like Morph like ever exist? It's like a consumer blockchain, like we had so many like sort of like general purpose blockchains. I'm honestly like not super familiar with what we're building, but I remember I just read like the announcement once and I was like, dude, this is like, of course like going to fail. Like that's what I thought. Of course, I'm a little bit more pessimistic than you guys maybe. But yeah, like it's just like, hard because most of the valuations in crypto now are based on like, oh, let's compare this thing to this other thing. And personally, I think that's wrong. Like, I think the thesis for like to whether like, okay, we're gonna invest on this or like we're not gonna invest in this. It's like, okay, can this bring more people into crypto? Is this thing gonna have like PMF? I think it's the main way to compare things now are like, okay, so we went to a 10 billion FDB. Maybe if we invest in Movement, it's gonna go to like 2.5 and we're gonna be able to cash out and make money. Like that's wrong. I think like that's the way I see it. And like that incentive, like it still exists. And I think especially if you raise like a big fund, you have zero incentive to deploy capital on apps and especially like useful apps, which I think you could argue have been the biggest moonshots of this cycle. All of the projects that have made like a shit ton of revenue, made it except Solana, have been like, like Moonshot, Pumped Fund, Axiom, fold on like draw like super stupid apps that probably would not have been funded by VCs. They probably would not have been supported by like ecosystem guys at L1s. So I think that incentive still exists, and I think it's bad for crypto adoption, right? Because as a VC, you have an incentive to deploy on like infra because it has a bigger valuation, potentially a bigger TAM, and potentially the token is going to be worth more. And personally, I think that's bad. I think that's something that we need to eliminate. But I think it might be self-correcting in the way that these guys are all going to get wrecked. I know many funds are doing this now. I can name a few, but yeah, so, and I still think the incentive exists. And you see these big boys still raising funds, and I think they're going to get dragged on some point, but it still exists. I think in a sense, like VCs are also kind of like beta chasers where it's like they see a product and they see it's successful. Like, oh, layer was successful, right? Let's fund like more restaking protocols, like that sort of the logic. And like, I think that's kind of like not helpful. But yeah, instead of like, I think there should be a little bit more of like first principles thinking on the industry. And I think that's something that honestly, like we're completely lacking now.
So I agree with part of what you said, and I disagree with other parts of it. The thing to realize is that there was a quote that I heard very recently, which I thought was very good, which is that when you look back through history, everybody knows about the concept of fog of war. But when you look back through history, you see the man and you see the battlefield, but you don't see the fog. Which is that it looks really obvious in retrospect how things are going to play out, going to several years into the future. It's not at all obvious when you're looking at an investment landscape of, hey, this founder comes to you. They have this idea. They say that this thing can be this big. Here's what they think the incumbent is doing wrong. Here's how they think they can take over the market. And when you're making an early stage investment, like the idea of like, well, there's already a guy out there who's doing this and I think they're already pretty good. So no, I don't think it makes sense to do this. If that's the attitude with which you're approaching investments, like you're just not a good investor. Now, that being said, that doesn't mean that every valuation is appropriate for making a seed bet. There are some valuations that are totally insane. But a lot of these deals that you're talking about, I don't know all these restaking plays. We didn't do any of them. But I want to defend the guy who does the Bitcoin restaking play, because who the fuck knows? Like you just actually don't know where it's going. And if you see this founder and you hear the story they're telling you and it's plausible, then the whole idea of investing is that you follow your conviction. Now look, if you cynically think that the market is stupid and it's magically going to cash me out, even though nobody wants this token, then basically you're betting on some kind of market manipulation, right? The reality, as you just said, is that the people who do this, they're going to die. Because if you just think that you can turn this thing into if you think the market is basically this like factory that produces, retail credulity for random slop tokens, you're just going to lose money, right? Like maybe somebody's going to make money from it. Maybe the founder will make money if they OTC this thing. Maybe the foundation will make money. Like I'm sure that Cayman directors are printing tons of money from doing this. But like as a VC, you're actually the last to get fed in that process. Because like all the unlocks, all the fucking, like the exchange is getting paid, retail is getting the airdrop, all these other people are getting out before you unlock even your first tranche of tokens, right? So it is actually true. And I can tell you, looking at the DPIs and the returns of a lot of these funds, a lot of the people who do this stuff, they're not making money. Like they're just not, right? It can't be both true that the VCs who do this are going to zero and getting corrected, and they're making a lot of money and they're sort of being quote unquote greedy by actually making returns. This is the way that markets chasten themselves, and the way that markets learn is by going through an iteration, people getting greedy, them losing money, and them learning and pivoting, and like the capital being reallocated to somebody else. So all this is to say, look, when you make an investment, even something like Morph, the investment that we made into Morph obviously hasn't worked out. It's been kind of a disaster with respect to, the team, people leaving, all this other stuff. But the idea that one of the biggest exchanges in the world launching their own chain and trying to bring some of their users on chain, to me, one of the most obvious pitches I've ever heard, right? Look at BNB Chain. BNB Chain is like number 2, number 3 on any given day on CoinMarketCap. You talk about retail adoption and bringing people on chain, absolutely enormous, right? Every exchange has been trying to do this forever. And the question is, okay, should exchanges keep trying, or should you give up and say, well, Base already won, Base is the best, despite the fact that, of course, Base is primarily US, right? BitGet, their market is overwhelmingly non-US, totally different set of users, most of whom aren't on chain. They're centralized exchange users. So to me, I'm very happy to have made that bet. Even whether or not that bet works out, whether or not I lose money, you can't, I used to be a professional poker player. You can't be results oriented when you're looking at investments. You have to look at what are the potential range of outcomes. And look, did these people play it the right way? As long as they didn't scam anybody, they didn't do anything wrong to anybody, I'm more or less fine. Although I would have preferred it go a different way, obviously, because I prefer investments to do well. But I think it's still, the entire book hasn't been written. There are many, many companies that go through really, really dark times, really, really horrible experiences. I mean, look at Uber. Uber was one of these quintessential examples of this. That company was a shit show. Everybody was saying like, oh my God, this company is corrupt. It's doing terrible things. And it ultimately pulls through. So as an investor, you never want to write off one of your investments unless you know for certain this thing is dead, because we've been surprised many times. I actually just had, I was just told a couple of weeks ago about a financing of a company that we invested in like, what was it, 2020? That is just raising a new big round. Apparently they're now profitable, despite the fact that they were just basically left for dead. We thought they weren't going to make it. So this kind of stuff happens, and venture is unpredictable in that way.
No, I completely agree with you. I think also like what I was saying was not necessarily like, hey, like don't invest in their restating protocol, and like don't invest in more, because I think it's like harder to see for sure. But I think it's like there's like this certain logic, like on like BCs that I have seen, that it's like, okay, this went to I get 10 billion FDB, so we're gonna invest in this because it has the same like hallucinatory properties that it can go to like whatever. So like I think that's what I'm against. I think if there's like a reason behind it, and like, okay, so now that he mentioned it like this way, like, okay, maybe we can target users in like Southeast Asia, like, I don't know, like we do like a Del 2 for them. It makes a little bit more sense, but it's like, I think many people are not thinking this way, And like, I think that's something that is wrong, and I think it's something that we need to correct. And I think it's better if we catalyze this as like a market, because these people do not want to see crypto succeed. They just want to sell useless tokens to like unaware retail investors. And like, honestly, like this pisses me off. Like personally. So that's kind of like a thing that I'm against. Mostly like beta chasing, just for the fact of like beta chasing. Like there's like a new category, like a BC, as a BC, you feel like, oh shit, there's like this new category. In case it's big, we might need exposure. You do zero research about the new category and you just invest. It's like, dude, you're like useless, man. Like you're useless. Like it's like as a founder, it's
Not
like,
everyone does that. Not everyone does that.
I do agree. Like I'm not saying everyone does that, but it's like as a founder, like I think you go to a BC and like they invest in you, like maybe they have like, you felt like, okay, they have like a good name, and like you realize like they do not know anything about your category, and like they just like they're just like there to make money, and it's like it's tough, right? Because it's like, of course, like everyone wants their investment to be profitable. I think that's part of life. I'm not against VCs making money, but I think it has to make sense, Like I think people have to like provide value to you as well, and they like what I'm against is just beta chasing for beta chasing. Like that is like, oh, you category, I'm gonna invest. I don't know anything about it. You guys figure it out. I think that's bad. I think that's bad for like the industry. I think that's bad for builders, and I think that's also like bad for VCs.
Yeah.
I think it's always
I had this debate with Gort, and Gort is like very seemingly anti-crypto VC, or I should say anti-tokens. And I feel like the kernel of all of this, right? Because one of the things that you see very quickly if you're a founder is that the way your investors treat you is very different from the way that retail treats you, right? Which is that retail is extremely sensitive to ups and downs, right? Token goes down instantly. You're a scammer. You're a terrible person. How could you have done this to us? Even when a token is an airdrop, so literally people got tokens for free, they'll still get incredibly mad at you. Like nobody even bought the token yet, and people are already mad at you. And investors, like part of the reason why venture capital emerged, and part of the reason why I think a lot of founders prefer to raise their first money, not from a crowd sale, not from an echo round, not from whatever, but to raise it from institutional VCs, is they know institutional VCs are patient capital, right? We know how to buckle in. We're quiet. We're patient. We're chill. Look, if you defraud us, we're going to come after you. But as long as you're doing the right thing and you're more or less, honestly failing, it's cool. It's totally fine to fail for your VC. Actually, most projects fail, right? Retail does not have that view. And most people don't have this intuition at all. Most people feel like if you failed, if you take something like Scroll, right? Scroll, they launched an L2, didn't do well. Everyone is so mad at Scroll. We didn't invest in Scroll. I don't know the Scroll team that well, but like as far as I can tell, Scroll just did an L2 that didn't work out, and people are so angry at Scroll. They're so incredibly. It's like the worse than many of the scammers that I see in this industry.
I mean,
like
they farmed around airdrop. And I mean, like, they gave like so much of the supply to Binance. Like, I think it's like, so the issue with Scroll is that they promoted the airdrop like pretty heavily. And then like the team got like a big chunk of the airdrop. Then like they gave like away most of the supply to Binance to get listed. And then like, I mean, like, of course, like people are going to get pissed because essentially if you farm this clone airdrop.
Just to pause for a second. This idea of like you're giving your supply to Binance, like Binance gives that supply to BNB holders who are also people who are basically getting free money, right?
Yeah, it's airdrop.
It's another airdrop. It's just more airdrop. It's just not CT airdrop, right? Most CT is not on Binance. So, but it's just more airdrop, right? It's just like, oh, this airdrop went over here, this airdrop went over there. But people are really, really mad about that. Now, look, if they were farming their own airdrop, that's shady. I don't know anything about that. I've obviously not been following the story very closely. But like the high order bit is not that they were farming their own airdrop. The high order bit that Scroll is down. If Scroll was up, nobody would care about any of this, right? The reality is the Scroll is down, and retail is very quick to punish failure. Like they love punishing failure. It's like and to be clear, this is not a crypto thing. This is like a universal human thing. Like people were so mad at WeWork, even though the only people who lost money was like Masayoshi-san. But people are just, it's so incensed by failure. And that's one of the things that VCs do is they're just like, look, failure is the modal outcome in company building, right? Most companies fail. Like that's always been true. The median lifespan of a company in the S&P 500 is like 20 years, which means within 20 years, you will fail after entering the S&P 500. Right. So to say companies that don't enter the S&P 500, it's even faster that your lifespan goes to the end. Sorry, Robert, go ahead and jump in.
I was going to agree. I definitely think that most companies fail, and there's a chasm between how VCs understand that and how the investing public understands that. But that's probably because the timelines are just also sped up in a weird way. Like when public companies fail in traditional markets, it's not a big deal and everyone sees it coming because there's like 13 different quarters of earnings reports that start going bad, and like the writing's been on the wall for years and years and years. In the case of a crypto project that fails, whether we use Scroll as an example or any of these things as examples, usually like the death knell is surprisingly quick. And it comes out of left field and everyone's caught off guard by it. And so yes, people don't expect these things to fail because there's not often as many warning signs. And there's a lot of token holders that maybe came in literally like weeks before, or there's just a totally different velocity to this. And so I completely agree, but I think one of the reasons for this is just the extreme speed at which all of crypto is operating. And when things fail and you feel misled because they were hyping it up just like a few days prior, you feel rugged. And whether that's, an L2 or whether that's Celsius or whether that's whatever, the failures sting a little bit more.
Yeah, I totally hear that. I think a lot of the reason for that is that these are basically like Series A stage companies, right? Series A stage companies fail really fast. Like that's just how it works.
Especially fast in crypto.
Yes.
I think also the issue is that if you look at like crypto dynamics from fundamentally, it's very different to build in crypto than to build in any other industry, because in crypto, like it's very weird because as like a random like community member of a project, you can like approach the founder and be like, Joe, I think you're fucking up. And many times the founder is gonna reply to you. It's like a little bit more democratic in that way. Like I think that's personally, I think that's very nice. Like I think that's actually very nice. But like the double-edged sword is that yes, people are gonna be turbo pissed if something goes wrong, especially because it's like, I think another thing that catalyzes this is that liquidity events are like happen much faster in crypto, right? Like if I'm founding like a Web2 startup, like I might not even like get a liquidity event at all, but fail. But in crypto, like I might get a liquidity event, fail, but still the founders might make like a lot of money. Like I think that's something that is wrong about the industry too, because it's like you might launch a project that had no PMS, but you can still make like a big chunk out of it. Like as a founder, I think that's like, honestly, like I think that's wrong. And I think that's also like something that pisses people off. But I do agree with you. Like sometimes like as like, yeah, like retail investors, like they're just going to try to like crucify you for like whatever you did. But it's like, but again, it's because many of the market dynamics in crypto are a little bit skewed towards like institutional and also like founders.
I agree with that. That being said, I think people are also overestimating how much liquidity these founders are getting. Like in the case of a movement, obviously, okay, you're dumping your tokens. What you're doing is pretty flagrant. Yeah, okay, you're cashing out. Most of these tokens that fail, like the founders don't cash out. Like we know them, they're like they go want to raise for the next thing, and they're like, yeah, I don't have money. Like I didn't get out. Like the token collapsed. So now, is it true in every case? No. There are certainly cases where people are OTCing stuff, or cases where even there are secondaries that are happening before the token launches, right? There obviously were many such cases in 2021, 2022, where that was happening. But that was also true in venture generally, right? You saw the same thing happen with, what was it? Hopin, right? That thing that raised a shitload of money from A16Z. That was like the video conferencing thing. Same thing happened with WeWork, right? This kind of stuff happens all the time. And the answer is, yeah, that's kind of capitalism. Like, it's unfortunate, but if you want free markets and you want the ability for anybody to be able to transact with each other, it's kind of incompatible with this moral intuition that many people have. And Gore was expressing the same thing to me, which is that if you don't win the game, it's not okay for you to make money. And winning the game doesn't just mean you have this FTV or you have this float or whatever. It means PMF. If you don't have PMF, you don't get to make money. I don't care how big you are. I don't care how long it's been. And of course, real markets don't work this way. Right? Like, look at biotech.
Look at SPACs, by the way, where like every single one of the SPACs is a total gutter dumpster fire, and almost all the sponsors have rode off into the sunset with huge bags of cash.
Again, right. I really expect more like a huge scam, fucking shemath. But anyway, I think it's a little bit different in crypto again, because it's like, in crypto, if you look at most of these companies in like traditional venture, like retail investors are actually not involved. No one really cares, right? Like, but if as like a token holder, like, okay, so again, it's like a double-edged sword, because again, you get like maybe like free marketing from people who have bags and things like that. But like if things go wrong, they are gonna be pissed at you because they are financially invested, Yeah. And like I kind of agree with Word that I think here, like the underlying like dynamics are a little bit different, in the sense that like as a retail investor, like if you're getting involved very early on, because like, guys, this is just like a reality. Like in crypto, like retail investors do get involved on companies early on. Even like pre-TG companies are gonna be like, oh, be part of like a community or like whatever bullshit. So it's like, not necessarily bullshit, but it's like they want that, right? So if you're gonna involve retail investors and like the token is not gonna go well, I do feel like you sort of like, as the captain, you should sink with the ship. Like, if you're building something like, I don't know, like fire blocks and you fail, I think that's like way different, because like retail investors do not have like direct exposure to that. So it's probably like fine. But I think you're ignoring the fact that retail investors have like a shit ton of exposure to these projects, and like sometimes many of them do get rocked, because I think unfortunately they are the last ones to eat in the pyramid. And like, again, like many people have like a seat to eat at the table like way before them, and it's incentives, right? Like if the incentives are there, like
yeah, to be clear, I completely agree with you that it's substantively different for a private company versus a public company. And for crypto, they basically go public within 12 hours of launching, effectively. Like all that being said, like what you're describing is basically the same intuition behind an investor protection regime, which is that only accredited investors should be investing early. Retail should not get involved in things that basically, in Gord's terms, don't have PMF, which is basically saying like, look, only certain levels of maturity companies should be allowed to go public. Is that like that is the way you square that circle, is to say that, well, retail investors shouldn't have access to this because they're the last to eat, they're the least sophisticated. That's why the investor protection laws emerged, is to protect them because they need protecting. Is that your view?
No, I think my view also, like personally, like I'm actually like very bullish tokens. like not all tokens, right? But I think tokens are like a very nice way to like align incentives and also like give like retail investors like skin in the game. But I do think there needs to like be a little bit more like transparency around like what's happening behind the scenes, so that as a retail investor, I can get a clearer idea of like, hey, I'm investing in this. Like I do agree with you that like I don't know, like I read like I saw like a paper from NYU that it's like someone in the stock world like looks up things for like 6 seconds before deciding whether to invest or not. So
That's how I do
minutes.
that's
6 minutes. A
no,
little bit
6
better.
minutes. 6 minutes, not 6 seconds.
okay, I say 6 minutes. Sorry, yeah, you're right. So you had the number 6, but I think it's like, so I think tokens are like a very like good distribution mechanism, but I think they're not being leveraged the right way. And I think the way incentives are set now, they're set to benefit only like very few players, like exchanges, market makers, like VCs, and like KOLs, and like not as elite retail, right? I think the way we make crypto grow is actually by like, like giving like retail investors like good opportunities. I think that's why because like we're so popular. In the end, like they became like very extractive and like kind of like a shit show. But again, like I think we should use tokens more for like social coordination purposes, because like they could actually be very bullish. And I think like the way I see it is like I think tokens and equity are probably going to converge at the same time. Because if you look at the process for like a company to IPO today, it's also like completely like nonsensical. You have to pay like, many companies are choosing to stay private because it's like you have to pay like a bunch of like advisors. You have to give like 10% of your company to like investment bankers and stuff. So it's like a coin. So it's like, in a sense, I think tokens are like a very good mechanism to replace it. But I do think we need a little bit more clarity into like how dynamics work. And I do think, because it's like, if you're a retail investor and like everything is public and like you get robbed, you cannot blame anyone. It's like, dude, everything is public. Like you got robbed.
Yeah.
They don't have like a right to be mad. But if you invest in something and then you find out that one of the founders did a deal to cash out OTC with their market maker and like their entity in Dubai, you have a right to be pissed, right? And I think
Totally
this
agree.
happened
Totally
any of the
agree.
base, right?
Yes,
Because also
yes.
like when as a team, like you mentioned Scroll, they had like a huge information asymmetry in which Duisha used to farm their own airdrop. That's wrong, man. And I think that's something that I kind of agree with Ward, that it's like, if you're involving retail investors and you're not telling them the full story behind what you're doing, like everything that's happening behind the scenes, they do have a right to be pissed at you because you're taking advantage of an information asymmetry to make yourself wealthier. And I think
So that I completely agree with. I think if you're not disclosing certain things or you're lying about certain, I mean, that's just fraud if you're lying. But even if you're not disclosing or you're omitting information that an investor would need to understand to make an investment, I think that is what we need to root out. And it's a little bit tongue in cheek, but I do think AI solves a lot of this eventually, is that 6 seconds can become an hour very easily for even a retail investor.
6 seconds of ChatGPT is all you need.
Yeah. But so speaking of, before we wrap, one of the things you mentioned, Mosi, was the painful process of IPOing and bringing a token, bringing a stock public. Robert, you recently announced something for Superstate, which actually connects very closely to this. Do you want to talk about that?
Sure. I'll give a brief overview of what we announced at Superstate. In addition to being at Robot Ventures and a host of the Chopping Block, I also do the hard work of building stuff. KOL. One day Mosi is going to yell at me because of something and a project failing, or, we'll see. But, what we're doing at Superstate is we're helping companies that are public, in addition to their stock trading on traditional stock exchanges like the NASDAQ or NYSE, to have their shares traded on DEXs, on blockchains. And we've built out the technology to enable this. We're working closely with regulators and coming up with a plan to enable this from a legal perspective as well. And our hope is to very soon launch equities on chain where they can do cool stuff, not just, be traded, but be fully programmable and live up to the sort of expectations that we all have for the cool things you can do with the token in DeFi. And so one day soon, stocks on chain, one day soon, IPOs on chain. And one day soon, lots more public companies, slowly over time failing after writing quarterly reports.
So, Robert,
I'm curious, but you guys are broke with it, Laura, really?
No, we're a transfer agent, and that's the technology that we use to record ownership and transcribe it to a blockchain. So the trading of it is not part of what we do. We're simply taking shares and digitizing them, not creating an exchange or a platform.
Awesome. I've seen a huge amount of fanfare about this announcement. I guess my question, and maybe to help build the intuition for the audience, what took so long for this to happen? People have been talking about this for like as long as I've been in crypto. Like, why did it take so long?
Yeah, why now? A couple of reasons. At this point, we finally have the ecosystems with the users built out. There's a variety of wallets across blockchains that have more than 10 million active users. And people are a little fed up with trading meme coins. All the technology is here. It's all been proven out. We've done 100 shows on the chopping block about how all of this stuff works through crisis and hoopla. Trading on-chain has been proven at this point, and I don't think that's a question anymore. And finally, I think we have the legal and regulatory tailwind for this to occur. The prior 4 years, even though this is legal and would be legal and is envisioned in the securities laws. I mean, almost all securities and stocks used to trade on a peer-to-peer basis, like all of them back in the day. We had a hostile regulatory environment that didn't want any innovation to occur. And that has switched 180 degrees. So all of these things line up for the time being now to be able to put new assets on top of the tech that everybody has been building for the last couple of years.
Okay. Mosi, do you approve? Is this rug resistant?
Yeah, I mean, like, honestly, like, I'll need to check out of it, but I would like to know, like, how, if you have time, like, how liquidity dynamics work. Because it's like, the way I see it, it's like, I think the biggest challenge of this is like making sure like there's liquidity, right? Because it's like, if you look at like pre-market and like after hours of trading on Eon stocks, it's like liquidity dries up like a ton. So it's like, I'm just curious and like, you use like an oracle price, like I'm just curious of like how that happens. Like I'm just wrapping my head around it. Like that's always been my question with like 24-hour stocks on chain. Like how will liquidity dynamics actually water?
Yeah, I mean, the underlying concept is that a market maker should be able to traverse DeFi to NASDAQ, right? And be able to move shares between the two. And if they do that, then the free market should keep these in line. Now, on nights and weekends, you might have an independent price. And it's possible that when, the market comes back Monday morning, the two converge either at the DeFi price or the NASDAQ price from Friday night. But that's decided by the market and the invisible hand.
Right. And there's real
markets are really good
right?
at this.
This is not a derivative.
Yeah, it's not a derivative. It's the canonical shares traded on either the NASDAQ or on a blockchain.
Right. Okay. I know we've got to wrap. Mosi, thanks for coming on and sharing your insight with us. It's been real, and we look forward to seeing you out there on the Twitterverse.
Keep everyone in line, Mosi.
Yes,
Thanks,
guys.
everybody. See you all next week.